Gold just lost $90 in a single morning.
Yeah, it was a brutal drop.
Right, just shattering that $4,000 floor. But the most surprising part about this is that the Middle East is really tense right now.
Oh, absolutely.
And inflation is proving incredibly sticky, and the global economic outlook just feels, highly uncertain.
It does.
So by all traditional rules of the financial markets, gold should be skyrocketing right now, right? As investors look for safety.
You would certainly think so.
Yeah, but today we are decoding why the market just, tore up the traditional playbook and what it means for your own portfolio. We have a substantial stack of market analysis reports, institutional newsletters, and investment strategy briefings from this morning, June 30th, 2026.
It is a lot of data to sift through today.
It really is. Joining us to help make sense of all these moving parts is senior market analyst Dr. Khalid Al-Nuaimi. Our mission for you today is to cut through the noise, examine the actual mechanics driving this aggressive sell-off, and outline the strategies the professionals are recommending.
Happy to be here, and yes, there is a lot to unpack.
And before we get into the details, if you find this deep dive helpful in navigating the markets, please take a moment to like the video, subscribe to the channel, and leave a comment below. It really helps us ensure you never miss our morning, noon, and evening market updates.
Absolutely, it makes a big difference.
Right, let us unpack this. We are looking at a brutal sudden shift here. Gold is down $90 an ounce, breaking below that massive $4,000 psychological barrier.
It is a massive barrier.
Yeah. And as we look at the trading data right now, it is fluctuating in this very vulnerable zone, between $3,990 and $4,020 an ounce. The sources describe this as severe technical damage.
They do, and the terminology they use there reflects a very real shift in market behavior.
How so?
Well, when an asset trades above a major whole number, like 4,000 for a significant period, institutional trading algorithms and retail investors alike, they begin to view that number as a foundational baseline.
Right, like a safety net.
Exactly. They program their systems to buy whenever the price dips near it. But when the selling pressure is heavy enough to punch right through that baseline,
the net breaks.
Yes, the net breaks, and the entire psychology of the market inverses. Those automated buying programs shut off, and the automated selling programs trigger.
Oh, wow. So it is not just a change in sentiment. It is like a mechanical shift in how the trading computers are behaving.
That is precisely what it is.
So is breaking the $4,000 mark like a psychological floor that just gave way under the market's weight, and now we're falling into the basement?
That is a great way to look at it, because it creates a ceiling now. In the immediate term, any attempt to push the price of gold back up is going to encounter massive resistance.
From people trying to get out.
Yes, from sellers who are just trying to exit their positions right at that $4,000 mark. We are witnessing a highly aggressive rotation of capital here.
Where's it going?
The money is flowing out of safe haven precious metals and moving directly into assets that offer a guaranteed yield.
I want to challenge that slightly, though, because I'm looking at the data for the broader precious metal sector, and, silver is sitting quietly in the corner, completely unbothered.
It is a very interesting divergence.
Yeah, it has remained remarkably stable, trading right in the $57.50 to $58.50 range. If capital is fleeing precious metals, why is silver holding its ground while gold drops $90?
Well, silver operates under a dual mandate, really.
What do you mean?
So gold functions almost entirely as a monetary asset and a store of value, right?
Yeah.
Investors buy it just to park their wealth.
Right.
Silver, on the other hand, is heavily an industrial component. The manufacturing sector provides a baseline of demand that gold simply does not have.
Ah, I see.
Yeah, the analysis points out that silver's current resilience is being anchored by that industrial consumption.
So we are talking about the physical materials needed for clean energy infrastructure, electric vehicles, high-end electronics.
Exactly. The physical demand for silver in those sectors does not stop just because the financial markets are volatile.
Because they still have to build the cars.
Right. Manufacturing companies are purchasing silver right now because they have production quotas to meet. They need the physical metal on their factory floors today.
So that acts as a buffer.
It does. It creates a massive structural cushion for the price of silver, completely insulating it from the purely financial sell-off we are seeing in gold.
But wait, if we are seeing a rotation away from gold because investors are worried about stubborn inflation and high interest rates, which typically slow down the economy, wouldn't that economic slowdown eventually hit the manufacturing sector too?
It is a valid observation.
It seems like silver might just be on a delayed fuse.
Well, if we enter a deep, prolonged recession, industrial demand will absolutely contract, and yes, silver will feel that impact.
Okay.
However, the current data suggests we are not in a recessionary collapse right now. The manufacturing commitments for green energy and electric vehicles, they're often backed by long-term government subsidies.
Oh, right, the multi-year corporate contracts.
Exactly. Those production lines are still running at full capacity today, which is why silver is holding its price in the $58 range for now.
Let us get back to the core mystery of this deep dive, though. If gold is supposed to be the ultimate safe haven asset, why are investors abandoning it?
It comes down to the macro environment.
Because the macro headlines are incredibly tense. The world feels unsettled. It seems entirely counterintuitive that institutional money managers are dumping gold and running toward the US dollar and government bonds instead.
To understand this, we have to look at the mechanics of opportunity cost in a high interest rate environment.
Opportunity cost.
Yes. When global conditions are uncertain, investors absolutely want safety. But institutional capital is entirely unsentimental.
Meaning they just care about the math.
Precisely. If they can secure safety and simultaneously receive a robust, guaranteed financial return, they will allocate their capital to the return every single time.
Because holding gold is essentially like renting an empty warehouse. You are paying for the security, but the building itself is not generating any income for you.
That analogy captures the institutional dilemma perfectly.
You are just hoping the property value appreciates enough to justify the cost of keeping it.
Right. Gold yields 0% interest. You only make money if the price goes up. Now, we must look at the US dollar.
The DXY index, right.
Yes, the DXY index, which tracks the strength of the dollar against other major global currencies, is sitting very high above the 101 mark.
Multi-month highs, according to the reports.
Exactly. And because gold is globally priced in US dollars, a strong dollar automatically makes gold significantly more expensive for any investor buying with euros, yen, or pounds.
It effectively chokes off international demand before the transaction even starts.
It creates a severe currency headwind. But the more powerful mechanism here is the bond market.
Ah, the treasuries.
Right. U.S. 10-year treasury yields are stubbornly elevated, hovering right around 4.37 to 4.38%.
Which is high.
Very high. Imagine you are a fiduciary managing billions of dollars in pension funds. Your mandate is to protect that wealth and generate reliable returns. Risk-free government bonds are currently offering you nearly 4.4% annually.
So if I have $1 million to protect, I can either park it in a vault full of zero-yield gold and cross my fingers.
Yes.
Or I can purchase U.S. treasuries, take zero principal risk, and get handed $44,000 a year in guaranteed interest.
Exactly. The mathematics make it nearly impossible for institutional managers to justify holding large allocations of gold under these specific conditions.
The opportunity cost is just too high.
It is. Capital is being actively siphoned out of zero-yield assets and reallocated into government bonds and cash equivalents.
And what is driving those high yields?
The root cause of these high bond yields is that the broader U.S. economy has remained resilient. It has not weakened enough to drag down sticky inflation.
Which forces the Federal Reserve to maintain a hawkish monetary policy.
Exactly.
And a hawkish policy means they are keeping those interest rates elevated, refusing to cut them. I read in one of the strategy briefings that the market is even pricing in a small probability of further rate hikes rather than cuts.
Yes. And any expectation of higher rates acts as an immediate downward force on gold prices.
Well, let us bring geopolitics into the equation, because this is where the market behavior seems completely inverted to me.
How so?
Usually, the moment there is friction in the Middle East, we see a massive spike in gold as people panic buy. But the current situation with the United States and Iran is having the opposite effect.
It is a very unique dynamic right now.
The sources are indicating that the U.S. and Iran are actually making preliminary progress in negotiations. They are circulating a memo to step-by-step unblock the Strait of Hormuz.
Yes, the diplomatic channels are moving.
And because of that specific easing of tension, oil prices are sliding downward. WTI crude is sitting at $70.30 a barrel, and Brent crude is at $73.54.
The interplay between oil and gold here is a fascinating study in market transmission mechanisms.
Transmission mechanisms.
Right, so you might assume the initial conflict in the Strait of Hormuz would have triggered a gold rally.
I definitely would have.
But paradoxically, the threat of that conflict actually generated downward pressure on gold.
Let me map out the causality here, because it feels like the market is playing three-dimensional chess.
It often is.
So the market is not reacting to the geopolitical conflict itself. It is reacting to what that conflict does to the price of oil.
Right.
Oil dictates shipping and manufacturing costs, which dictates inflation. And inflation forces the Federal Reserve to keep interest rates high.
You have identified the exact chain reaction.
Wow.
When the shipping lanes were threatened, the bond market immediately priced in the risk of oil spiking well over $100 a barrel.
Which would be an inflation nightmare.
Exactly. A severe oil spike guarantees persistent elevated inflation across the entire global supply chain. Persistent inflation guarantees the Federal Reserve cannot cut interest rates.
And as we established, higher interest rates make gold an unattractive asset to hold. So the institutional investors were not watching the news and thinking, buy gold for safety. They were watching the news and thinking, oil is going to cause inflation, which means the Fed will hold rates at 5%, which means I need to sell my gold.
It demonstrates that the most significant factor for gold is no longer geopolitical fear.
What is it?
It is the mathematical reality of Federal Reserve policy. The geopolitical risk only matters in how it alters inflation.
That makes so much sense.
However, because these negotiations are progressing and oil prices are actively dropping, the inflationary pressure is beginning to cool.
Which provides the Federal Reserve with the exact economic cover they need to eventually become more dovish, meaning they can afford to be more lenient and consider cutting rates in the future.
Yes, exactly.
And a dovish Fed is highly beneficial for gold in the medium to long term.
So the de-escalation in the Middle East is actually laying the structural groundwork for gold to recover down the line, even though the immediate reaction today is a $90 price drop.
That brings us to the holding pattern we are currently in. Since the Federal Reserve's policy is the ultimate driver here, the entire market is essentially frozen in place.
Everyone is waiting.
The traders are just staring at the calendar, waiting for the specific macroeconomic dials the Fed uses to measure the economy. And this week we have a massive lineup of U.S. labor data.
The labor market is the primary indicator the Federal Reserve is monitoring right now.
We are waiting for the JOLT test report, the job openings and labor turnover survey, along with the ADP employment report, the non-farm payrolls, and the overall unemployment rate.
It is a heavy data week.
Furthermore, the Fed chair is scheduled to deliver a highly anticipated speech at the European Central Bank Forum in Portugal. Central bankers do not speak at these global forums casually, do they?
Never. They use them to signal major policy shifts to the financial world.
Right.
The market will scrutinize every single phrase used in Portugal for clues about the timeline of rate cuts.
So let us game out the practical scenarios based on the data we are expecting.
Let's do it.
Scenario 1. The job numbers come in hot. The economy is adding hundreds of thousands of jobs, and unemployment stays low.
Okay.
That means the Federal Reserve remains hawkish, the U.S. dollar strengthens further, bond yields stay above 4.3%, and gold faces another wave of aggressive selling.
Correct. A robust labor market validates the Fed's decision to keep rates high, which continues to punish zero-yield assets.
Scenario 2. The job numbers come in weak. The economy is clearly slowing down, companies are pausing hiring.
Right.
The Federal Reserve finally gets a signal to back off, the dollar weakens against other currencies, and gold gets the green light for a massive technical recovery.
That is the alternative path.
This feels incredibly cynical, though. If you are a listener holding gold in your portfolio right now, you are essentially watching the news and rooting for the economy to falter.
It is a strange position to be in.
You want bad jobs numbers just so your investments increase in value.
It is a cold reality of how high-rate environments function. The phrase often used on trading floors is, bad news is good news.
Bad news for the economy is good news for gold.
Exactly. A weakening labor market is the specific permission slip the central bank requires to begin lowering the cost of borrowing.
I see.
The moment the market believes a rate cut is imminent, the opportunity cost of holding gold vanishes and capital will flood back into the metal.
So, knowing all these macroeconomic tripwires, the strong dollar, the bond yields, the Fed's deep reliance on this week's labor data, how should you actually position your investments right now?
That is the big question.
We have some very clear, practical advice from the analysts in our source stack, and they heavily emphasize separating short-term tactical decisions from long-term strategic planning.
They are two entirely different mindsets.
Let us start with the short-term outlook. The consensus is unambiguous. The immediate trend is downward. For short-term traders, the primary warning is to avoid chasing the market.
Attempting to predict the absolute bottom of a downward momentum swing is a highly dangerous strategy.
Don't try to catch a falling knife, as they say.
Exactly. The recommendation is to remain patient and wait for undeniable technical confirmation that the trend has reversed.
And they talk about leverage, too, right?
Yes. The reports strongly advise against using high leverage in this environment. The current volatility could easily liquidate a highly leveraged position before the market ever has a chance to turn in your favor.
However, there is a distinct note of reassurance in these briefings. The analysts emphasize that a catastrophic, systemic drop all the way down to the $3,500 or $3,700 range is highly improbable.
Yes, the fundamentals are too strong for that.
So the $4,000 floor cracked, but we are not falling into an abyss.
The underlying physical demand and long-term structural forces are far too robust to permit a total collapse in the price.
Which leads us directly into the long-term outlook, which the sources describe as overwhelmingly positive.
It is a very bullish long-term picture.
Looking toward the second half of 2026, there are massive catalysts building beneath the surface. One of the most significant is the continued aggressive purchasing by global central banks. We are talking about the overarching trend of de-dollarization.
We must look at the mechanics of how de-dollarization actually works.
How so?
Well, foreign nations, particularly in emerging markets, are actively seeking to insulate their sovereign wealth from U.S. sanctions and currency fluctuations.
Right.
They do this by restructuring their reserves. Instead of holding their national wealth in U.S. Treasury bonds, their central banks are systematically purchasing physical gold bullion and storing it domestically.
Taking it completely off the market.
Exactly. This removes massive amounts of physical supply from the global market, creating a permanent layer of baseline demand.
And they are doing this at the exact same time the U.S. national debt is skyrocketing. It creates a fascinating tension.
It really does.
On top of that, there is the wild card of potential financial shocks. One of the investment briefings specifically highlights the risk of an artificial intelligence market bubble bursting.
That is a very real concern for many institutions.
We have seen trillions of dollars pour into tech valuations over the last few years. If that momentum stalls and the tech bubble deflates, how does that practically impact precious metals?
Well, capital does not simply disappear when a sector corrects. It rotates.
Right.
If the massive valuations in the technology sector begin to collapse, institutional portfolio managers will be forced to urgently rebalance their holdings.
They pull the money out.
Yes. They will extract their capital from high-risk equities and immediately deploy it into defensive, safe haven assets.
And gold is right there waiting.
Gold is traditionally the primary beneficiary of that kind of rapid capital flight.
So for the accumulators, the listeners who are building a position steadily over time, the recommended strategy is to utilize dollar cost averaging.
Yes, absolutely.
You ignore the day-to-day noise and simply purchase your predetermined amount at regular fixed intervals.
It is a mathematical approach to neutralizing volatility.
Just keep quietly stacking bricks.
Exactly. By buying consistently, you naturally acquire more metal when the price dips, like today, and less when the price peaks, effectively smoothing out your average cost over the long run.
And for those who perhaps purchased gold right at the top, just days before this $90 drop, the advice is clear. Do not panic sell. Treat it as a long-term accumulated asset.
Panic selling is the worst thing you can do right now.
To summarize the professional guidance here, for the short-term trader, the rule is to protect your capital and wait for confirmation. But for the long-term investor, the strategy is simply to keep quietly and consistently building your position.
The short-term fluctuations, driven by temporary bond yields and monthly inflation reports, are loud and often intimidating.
Oh, very much so.
But they cannot erase the massive, undeniable structural realities of the global economy.
The debt, the central banks.
Right. When you analyze the mathematical trajectory of sovereign debt issuance, it positions gold not just as a trade, but as a necessary component of a secure, diversified portfolio.
Because historically, when fiat currency systems are stretched to their limits, gold acts as the ultimate financial release valve.
Always has, and likely always will.
Well, let us bring all of these threads together. We began by examining the sudden breakdown of gold below the $4,000 psychological barrier.
Right.
We discovered that it was not driven by geopolitical panic, but by the cold, calculated mathematics of opportunity cost, driven by a strong U.S. dollar and elevated 10-year Treasury yields.
The unsentimental capital rotation.
Exactly. We track the chain reaction from the easing tensions in the Middle East to dropping oil prices to cooling inflation and how that ultimately dictates the Federal Reserve's next move.
The 3D chessboard.
The 3D chessboard indeed. And we learned that the entire global market is currently holding its breath, waiting for this week's U.S. employment data to reveal the future path of interest rates.
It all comes down to the data.
It does. But before we conclude this deep dive, I want to leave you with a final provocative thought to consider based on the long-term trends our sources highlighted today.
Okay.
We are observing a monumental collision course playing out in slow motion on the world stage. What happens to the mechanics of the global financial system if this accelerating trend of de-dollarization, where foreign central banks refuse to buy U.S. debt and buy gold instead, collides with the exact moment the United States needs to issue more national debt than ever before in its history?
It sets up an unprecedented liquidity crisis.
Wow.
If the traditional international buyers step away, the mathematics of funding that debt become highly unstable.
Precisely. If the global appetite for U.S. bonds evaporates just as the supply of those bonds reaches record highs, will gold suddenly and violently reclaim its historic position as the only undeniable global currency?
It is a scenario we are watching very closely.
The $4,000 floor under gold may have cracked this morning, but the structural foundation beneath the dollar might be the one truly under pressure in the years to come. It is something every investor needs to be watching closely.
Absolutely.
Well, that is everything for today's deep dive into the June 30th market data. Remember, if you want to stay informed on these critical economic shifts, please like the video, subscribe to the channel, and drop a comment below. We want to hear your personal predictions for this Friday's non-farm payrolls report. Are we going to see a resilient economy or a weakening labor market? Let us know your thoughts. Until next time, we wish you a healthy, peaceful, and profitable day. Keep a close eye on the charts.